So they are in a very, very complicated situation where they've made sure to tell us that inflation is the enemy number 1, 2, 3, 4, and 5, and they're just going to keep going, regardless of how bad is the pain in all these risk assets, until they see an actual and pretty good progress on the inflation front. That is very different than the environment we have seen over the last 10 years.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson, and with us today a new guest, Alfonso Peccatiello, and he is the author of the Macro Compass newsletter and also the former head of a $20 billion investment portfolio. Alfonso, thank you so much for joining us today.
Elijah, it's my pleasure to be here. Let's have this fun and insightful interview, hopefully.
Definitely. Now, you've been reporting a lot on what the Fed has been doing and how really right now you are very bearish on the markets. And it seems like investors are very resistant to buy the dip at this moment as we're seeing a pullback in stocks and other asset classes. Your take on where we are right now and why you're not very bullish going forward on risk assets.
So Powell yesterday, for the 10th time, I think this year, has had an interview with, I think it was the Wall Street Journal, and he said a couple of very remarkable things. I want to read them just to make sure that I quote him right, Elijah, and our listeners can understand why I'm so serious about where markets are. So he says, financial conditions overall have tightened significantly. That is all we need to see for our monetary policy transmission to channel through the economy. And then he said, we have a clear job to do still on cooling down demand in the economy because we can't influence supply and demand needs to slow down. So it's basically telling you two things. A, we have quite a problem on inflation, and the problem comes from two sides. One is the supply side of the equation, where a lot of goods are not flowing the right way, energy prices are increasing, and all the supply bottlenecks we know that the Fed can't do much about, right? And he knows that. But there is the other side of it, which is demand. And as he has a problem about inflation, the only thing he can really do is to cool down demand. And he's saying that despite the sell-off we have had in equities, the sell-off in the bond market, the sell-off in credit spreads, volatility is higher, real wages are negative in the US, consumer sentiment is at the lows over the last 30 years. Despite that, yesterday, May 17th, Powell said we still have clearly a job to do on cooling down demand. So he's not done, anywhere done, in his opinion, because unless he sees inflation really slowing down, not only slowing down, but slowing down fast, he will keep on tightening. He needs to regain credibility in his inflation fight. And in this environment, financial assets are, just a bad place to be.
Now, I know you did state in an interview recently that the Fed is going to hike until something breaks. So do you see the Fed reversing if we do see a further fall in the stock market?
I would have said over the last 10 years, yes. On the Macro Compass, which is my free newsletter, I put out an article very recently, and I said, what if? What if inflation remains stickier than the Fed thinks it does? Because, Elijah, we're used to see the Federal Reserve every time basically moving, pivoting dovish every time there is a problem in a market. It's the credit market, it's the equity market. Everywhere there is a problem, they actually jump in and ease financial conditions. But why is that? Because inflation expectations were so low over the last decade. Realized inflation was below 2%. So they didn't have a problem in, restoring confidence in markets. But today, imagine something breaks. As I said, so let's say the credit market doesn't work, the repo market blows up, the equity market blows up, something like that. If inflation is still at 5% by then, what are they going to do? They're going to say, oh, we need to rescue the stock market now. They can't say that, otherwise their credibility on the inflation front will be completely lost. So they are in a very, very complicated situation where they've made sure to tell us that inflation is the enemy number 1, 2, 3, 4, and 5, and they're just going to keep going, regardless of how bad is the pain in all these risk assets, until they see an actual and pretty good progress on the inflation front. That is very different than the environment we have seen over the last 10 years.
Now, when it comes to the stock market, I know you are short currently. How far do you see it falling?
Great question. And so I have the short on since 4,400 in the S&P. It's now below 4,000 as we speak, around 4,000 as we speak. So it's 10% down. All right. I've been short several other risk assets at the beginning of the year, mostly credit spreads. So since December, as I said on the macro compass, I thought things were changing. Okay, good. I've been right so far. I'm often wrong as well. But now the point is how long to go. And Elijah, normally over the last 10 years, the few times I was short, I always had a level at which I felt the Federal Reserve could come in because, that would be too much. There would be too much of a dampening to demand and they would need to rescue the market. This time, that's not the case. This time, basically, as the economy literally slows down as well, then we're seeing the first profit warnings from supermarkets, from Target, from Walmart, even the consumer staples. They're having problem delivering the earnings they're supposed to deliver. As the economy slows down, and on top of that, the Fed has to tighten monetary policy. It's two bad things for the stock market. And because the famous Fed put, so the level at which the Federal Reserve would basically provide a floor to valuation, the floor to stock market, what is the Fed put today? I don't know. You tell me. The only thing I know is that unless inflation slows down even faster than they already projected to slow down, they cannot credibly come in and support markets. So I'm just going to keep my short basically until I see either a very strong progress on the inflation front, then I know the Fed can step off, right? And then things can ease a bit, or for some magic reason, the economy actually remains strong. But I can't see that happening. Wages are below inflation, purchasing power is getting eroded, and now the housing market as well is starting to slowly suffer. So I don't see good prospects. I'm just going to keep my short on.
It does seem like we have seen a huge bubble in the housing market. I mean, the stories that I've been hearing, people just buying, sight unseen houses with 100% cash down, or it's like, this is an insane market that we've been in. Where do you see that headed and why? So
the real estate market, Elijah, is the biggest market in the world by a large margin. So if you ask people and you say, what is the biggest market in the world? They'll tell you it's the equity market. And the equity market is big. It's about $100 trillion worldwide in market capitalization. The real estate market, summing up the residential, the commercial, and the agricultural land, is $320 trillion. It's 3 times as large. So it is by far the biggest market and the most systematic in the world. And we are used to see these house prices go up by 10% a year or so, leave it, take or leave, right? That generates the so-called wealth effect. It makes people feel richer. If you have a house on your balance sheet, Elijah, and your mortgage is fixed by definition, it doesn't float as market prices float. It's just a fixed amount, right? And on your asset side, the house you have bought because of a mortgage goes up in value, and obviously you're going to feel richer. You feel that if you sell that house and you're going to make more money, and then you can spend those money. And so you're going to spend these unrealized equity gains, capital gains that you have in your balance sheet. The Federal Reserve at the moment doesn't want that. They want the exact opposite. They want you to slow down demand. I'm paraphrasing Powell. We clearly have a job to do on cooling down demand. To cool down demand, they need to reverse this effect. They need to make sure that you don't feel like your house prices are going up 10% next year as well, so that you can count on that additional, buoyant spirit in spending. They want you to spend less. They want you to slow down. So what they're doing is they're making sure that mortgage rates go up. And how that does their work is that 30-year mortgage rates are now 5.5% in the US, and they were 2.9% just a year ago. That change, that quarterly or 6 months rolling change, is the fastest ever in the history of mortgage rates. So people who thought they could borrow and afford at a certain interest rate, a certain house, now they can't anymore. And the moment they can't, they're going to scale back on their ability to bid up all these house prices, and the housing market is going to cool down. And I think the Fed is fine if the housing market this year slows down actually by 5%. That's what they're looking for. The problem with the housing market is that the leverage which is involved in it is so big, Elijah, that it is difficult to control and to have this soft slowdown that they're looking for. So what I am looking into is signs of stress. And I'm looking, for example, this week we had the lowest ever mortgage applications to purchase a new house. The data was just out over the last 3 years, which tells me that buyers are scaling back. They can't afford this mortgage rates at these house prices. They just can't afford anymore. So then the next question is, where are the sellers? Is this inventory coming up to the market? And probably it is, because a lot of people have been on the sidelines and now they're like, ooh, actually my real purchasing power is going down. Maybe I need to sell my second house. So as the buyers retreat, the sellers come to the market, and the reaction to the housing market can sometimes be more unpredictable than we think. So it's one of the things I'm watching closely.
In 2008, when we saw the crash of the housing market, that crisis really reverberated throughout the whole financial system. How do you see the pullback or crash in the housing market affecting the rest of the financial system this time?
Well, of course, in 2006, 2007, we went ballistic with housing products. We had interest-only mortgages where you push your final bullet repayment at the end of the maturity. And so, of course, it's cheaper to borrow because you only have to repay interest rates. We had all sort of even more esoteric formula where you packaged certain, mortgages in a product that was then packaged in another product, the famous CDO squared products, right? Regulation has been tightened very aggressively since then. So it would be hypocrite, I think, to come up and say, well, it's going to be the same level of pain if things slow down in a nonlinear way. What has increased since 2006, 2007 is the nominal amount of leverage in the system. So the private sector has become even more leveraged than it was, because as growth, our structural growth is slowing down, Elijah, because we become older, we don't make enough kids, and therefore the labor force is older and it shrinks over time. And so there are less people contributing to the economic growth. And so, of course, there is some technological advances and productivity, but real GDP growth on a structural basis is pretty poor. How do we solve the problem is we lever up, right? We borrow, we make borrowing cheaper. So if we can borrow more, then we all of a sudden have more money to spend, right? Then obviously this credit needs to be serviced and repaid at some point. And in the Macro Compass, I have an article called The End Game that looks exactly at this process. We keep on repeating the same. We borrow more and more. We lower the borrowing costs. So it looks like that all of this is repeatable as a process. And the housing market is at the epicenter of this process because it represents a lot of the borrowing we're doing. The policymakers I spoke to, Elijah, when I was running a $20 billion portfolio, unfortunately, they all think the same way. Nobody will ever volunteer to be the one that explicitly caused the crisis because they won't get reelected. It's very simple. They want to make sure they are in this controllable status quo sort of environment. So again, it is a highly leveraged market. Regulation has been tightened, so it's not as crazy as 2006. But the reverberation into other asset classes can be big because of the inherent leverage in this market. And on the other hand, though, regulators, if we really get to that point, I think will become very scared. And policymakers, as always, will try to keep this status quo situation and try and ease again things. But as I say on the Macro Compass, in this situation, things need to get worse before they get better. And we are in the situation where the Fed is trying to tell us pretty clearly that they need to slow things down further. So things have to get worse first before they can get better.
You mentioned how we are just kind of borrowing money from the future to pay for now because of demographic changes. Not as many young people as there are people who are not as young, right? So your perspective on that, what in your perspective is that end game where we have this huge debt bubble and what happens then in that case?
So as I say on the T-shirt, you can't fight demographics, and you can't because it's a long and slow trend that basically reduces your labor force. We age, we retire, we don't have enough kids to replace us, and therefore the labor force shrinks. And as we do that, Elijah, then we want to replace that missed growth, and therefore we borrow. We lever up the public sector and the private sector. Do not forget to look at the private sector too. Business leverage, private sector leverage, household leverage, and all of that. obviously you need to make borrowing costs cheaper, and cheaper. Otherwise, the additional leverage you can't afford anymore because your salary isn't going up that much. So if you want to borrow $1 million with this salary, okay. But if you want to borrow $1.5 million, then the additional $500K needs to be very cheap to borrow. Otherwise, you can't afford to pay it based on the same salary. And so it all has to do with real interest rates. Because when you borrow, it's not only the nominal rate that you pay, but then you're adding a liability to your balance sheet when you borrow, right? And inflation eats away the real value of that liability. If you borrowed $1 million now, in 30 years, if inflation has been very high, that $1 million is worth very little to repay in new money terms, right? In 30 years from now. So it's the difference between the nominal interest rate you pay and the inflation that eats away your debt burden. And so it's real interest rates. That's all they matter. And real interest rates have been dropping like a stone for 40 years. And there is a problem with real interest rates is that if nominal interest rates can't drop anymore, how can you lower real interest rates further? If nominal interest rates are already at zero, the only way to lower real interest rates is for inflation to be higher. But policymakers don't want inflation to be that high. They want to be controllably around 2%. So you reach a point where you are close to breaking points, right? And those breaking points are pretty scary because either the central bank has to lose control on inflation to make real rates very low, but they don't want to lose control on inflation. That's not their intention. Or they need to bring nominal interest rates to very negative levels, minus 2%, 3%, minus 5%. Those are like ridiculously low levels. And so you reach those situations where the reactions that the population and financial markets have to these situations are not linear anymore. It's not like, you ease and therefore I'm going to linearly do something. No, it's like you are bringing the game, you're stretching yourself too thin here on this game you're playing, and I'm going to take nonlinear reactions. And the nonlinear reactions are, I'm going to challenge the monetary system, for example. I'm going to maybe doubt about the viability of this monetary system. I'm going to look for new alternatives. And now historically, the new alternatives have been pegging the new credit, the new borrowing to gold. That has been used a lot in the past with the gold standard, which pegs the amount of real economy money to gold. So you know that you can always convert the fiat money to gold at a fixed price, which makes obviously creating new fiat money difficult because the gold can be created, right? So that is one way to change the system back to a hard asset that actually pegs the credit creation. But that doesn't solve the problem because we still have a very poor demographics. So how are we going to grow if we cannot do borrowing anymore because we're all pegged to a hard asset? But it is a thing to consider. People might think, let's go back to pegging credit creation to a hard asset. The other one is people might think, okay, where is the place that digital assets play in this new world? Because maybe we don't need to peg to gold. We can think about the system where also digital assets play sort of a scarce role we can peg to. And so you start seeing these bouts of volatilities towards these assets, and situations become non-linear anymore. So you need to have something in your portfolio for the long term, I think, that protects you against this scenario. And you don't know exactly when and to which extent does it happen, but I think it is sound to allocate a certain proportion of your portfolio to these assets.
Now, when it comes to investing in precious metals, I know recently you have been bearish actually on gold. Your take on that, how low do you think gold could fall? Because we have seen quite a bit of a pullback in the last couple months, and with silver as well, even more dramatic there. So do you see further to fall in the precious metals?
So there are two portfolios that I have on the Macro Compass and on Twitter that I update regularly. One is a medium to long-term portfolio. With the idea there is to preserve your purchasing power in real terms, at least, and to slowly increase it over time. So there, what you want to do is that if you accumulated $200,000, then you want to make sure that these $200,000 are effectively $200,000 in real spendable terms also in 10 years from now, possibly a bit higher. So that is a very medium to long-term portfolio where I always own gold, agricultural land, art, all these real assets that are scarce. They have an inherent value for humanity for some reason, like residential real estate, you have to live somewhere, and art and gold represent a monetary scarce asset and a valuable scarce asset, for example. And I always allocate about 10% of the portfolio to these assets to make sure that if I get closer to the point where, as we discussed, things can get challenged, then I have an asset in my portfolio that can protect my purchasing power, right? In that case. The other thing is the short-term tactical portfolio. That's where I take a view of 3 months, 6 months ahead, right? And I try to help investors navigate in a more tactical way their environment. And their precious metals are looking good, to be honest, because again, the Federal Reserve is telling us, guys, we need to slow things down. We're going to tighten monetary policy, and we want to bring inflation down. So what they're trying to do is to make real interest rates higher. That is contrary to the trend we have seen over the last 40 years, because, Elijah, they don't want to encourage further borrowing. They want the exact opposite. They want you and me to say, I can't get the credit card, it's too expensive. Another house, mortgage rates are too high. So they want us to refrain from additional borrowing. And how you do that is you make real borrowing costs higher. And as real interest rates go up, we all know there is an inverse correlation with gold. And real interest rates have been moving up very aggressively, and gold and silver had held up pretty well, I think also because of the war between Russia and Ukraine and the weaponization of the dollar reserves. So people got all scared and thought, okay, the Bank of Russia is going to go all in on gold. So there was a bit of this hype. And then at some point, this hype actually, reversed, and people start focusing again on the fact that real interest rates have gone up, and gold is inversely correlated to those. And so now it's starting to fall down. And why is it inversely correlated? It's pretty simple. Real interest rates are basically, especially on treasuries, on a risk-free instrument, are basically the reward you get by investing in a risk-free asset denominated in dollars, in real terms, right? In inflation-adjusted terms. If this reward is getting bigger, because real interest rates are going up, so you are incentivized to buy these treasuries, right, compared to the past in a marginal term, then the attractiveness of gold, which pays no dividend and effectively is a 0% inflation-adjusted asset, actually goes down. So as real interest rates go up, the appetite for people to buy gold on a marginal basis goes down. And as the marginal demand goes down, also the marginal price goes down. And that's what we are seeing now. And I do not discard another 5 to 7% drop in gold. Could be larger. Again, it's the same question when you ask about the S&P 500 or equities. Again, unless the Fed is able to say, okay, guys, we come back, it's fine, inflation has slowed down, no need to panic. Unless they're able to do that, there is only one way, in my opinion, which is to suffer and reprice financial assets more on the downside, including gold.
Now, you have stated recently that for those who aren't able to short the market, holding cash is actually a pretty good option at this moment for the short term. Your take on that?
Yeah, so cash has lost in inflation-adjusted terms this year something like 4%, something like that. So why am I suggesting an asset that loses 4% in inflation-adjusted terms? Yeah, because everything else is losing more. It's very simple. It's a relative game. So unless you can short, or you can do some inverse ETF, or you can do some leverage, or you can short some future contracts, so if you're a simple investor with a long only mandate, your objective is to try and keep your purchasing power, right? At least. And so at the moment, cash doesn't keep your purchasing power, but it is the closest form I think you can get to try and get close to that. Unless you own commodities, so far, there was basically no asset in the world that delivered a return which was higher than the realized inflation. That tells you, Elijah, how difficult is this environment. Because the central bank is telling you, I want the wealth effect to reverse. So you shouldn't own any asset that is included in this wealth basket. It's stocks, bonds, credit, gold, Bitcoin. At this moment, you shouldn't really own, because they really want you not to own those. They want the price of this basket to go down. And so cash obviously is, well, at least it loses only 4%. Sometimes you have to play defensive. You have to be humble in the markets. That's what I learned. And in this case, there is no reason to be brave. You just be defensive, raise your cash allocation, and prepare for future opportunities by building a war chest of cash.
You mentioned how pretty much everything besides commodities has fallen more than the loss that inflation would cause if you just hold dollars. But it does seem kind of like, well, if there is inflation and prices are rising, there has to be something that is rising, which I guess in this case was commodities. But is there anything else you see that will rise going forward? I mean, how do people invest and take advantage of the inflationary pressures going forward by investing in something?
Yeah, so if you expect inflationary pressures to remain, so let me rephrase. People think that inflation needs to go up from here for the Fed to freak out, and also for the ECB or other central banks. It's not really the case. I mean, inflation is already 8% in the US and like 5 or 6% in Europe. If it slows down, but it slows down to only 4%, for instance, central bank will freak out as well, because that means inflation is becoming persistent, is becoming sticky. So if you expect inflation to remain higher than what central banks have told you it will be, they have told you it will be 2 to 2.5% by 2024. If you don't agree with that thesis, then long-term in markets, you can actually own, I think, commodities and assets that are real scarce. That is the only thing you can try and own, but not monetary assets, because they will be tightening monetary policy. So gold doesn't work. You're restricting your basket basically and trying to look at assets that perform well when growth is slowing down and inflation is remaining stubbornly high. And I think commodities are the best candidate in that, and equities that are related somehow to commodities, and also international equities in that front. So emerging markets have been beaten up for decades, basically. Some of these emerging markets actually have a very good capacity to produce these commodities that we will need, and they will protect purchasing power in an inflationary period. Brazil, Chile, they produce soybean, they export copper, and all of that, for example. So this might be two ways to look at it, but again, only if you expect inflation to remain stubbornly high, then it makes sense to allocate some of your portfolio to commodities in that case.
All right. Well, Alfonso, we really appreciate your time today. People can find your Macro Compass newsletter in the description of this video. Can you tell us a bit about that? It's a free newsletter, so no commitment there if people want to check it out.
Yeah. So thanks for the chance, Elijah. I ran a $20 billion portfolio for 7 years, and then I basically quit because I got tired of corporate politics. I wanted to experience something else, which is to share my knowledge with you guys at the end of the day. That's why we're doing this interview, and that's why I write a free newsletter. It's called the Macro Compass. It's on Substack. So basically what it is, it's a weekly newsletter that provides you with some financial insights, some investment ideas. And I try to share my knowledge with you guys in a way that you can make more sense and connect the dots in the macroeconomic world and in financial markets. We're up to 47,000 readers, so apparently it's a very appreciated piece. And if you want to check it out, go and do it. It's all free.
All right. Alfonso, once again, thank you so much for your time, and God bless.
My pleasure, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan,
call 1-888-81-LIBERTY. That's 1-888-815-4237.